Credit scores are often shrouded in mystery, yet they play a crucial role in our financial lives. Whether you're applying for a loan, renting an apartment, or even securing a job, your credit score is a key factor that lenders, landlords, and employers consider. However, many people remain confused about what these numbers truly mean, how they're calculated, and how they can impact their financial future. In this video, we'll break down the essentials of credit scores, demystifying the factors that influence them and how they can affect your financial decisions. From understanding the basics to learning how to improve your score, we'll equip you with the knowledge you need to take control of your financial health. By the end, you'll have a clear understanding of why credit scores matter and how you can leverage them to unlock better opportunities in life. So let's dive into the world of credit scores and discover what you need to know. What is a credit score and why does it matter? Meet John Miller, a 30-year-old living in New York City. John had always paid his bills on time, but when he applied for a mortgage to buy his first home in March 2024, he was shocked to learn that his credit score was much lower than he expected. In fact, his score was only 620, which is considered fair by most lending standards. But what exactly is a credit score? And why did it matter so much to John's mortgage application? A credit score is a three-digit number, usually ranging from 300 to 850, that lenders use to assess how risky it might be to lend you money. The higher your score, the more likely you are to get approved for loans and credit at favorable terms. For John, his low score meant higher interest rates, making the dream of owning a home more expensive than he had anticipated. Understanding how credit scores work is essential, and in John's case, it was the difference between getting a home or putting off his dream. The secrets behind credit score calculation revealed. John Miller had a lingering question. Why was his credit score so low despite paying his bills on time? After some research, he learned that his score was influenced by 5 key factors. These included his payment history, amounts owed, length of credit history, types of credit used, and new credit inquiries. The largest factor affecting his score was his payment history, which accounted for 35% of the total. John realized that a few late payments on his credit card had hurt his score. The second most important factor, amounts owed, made up 30% of his score, and it turned out that his credit card balances were near their limits, which was a red flag for lenders. Next, John discovered that length of credit history contributed 15% to his score, and since he hadn't had credit for long, this worked against him. Types of credit used, 10%, and new credit inquiries, 10%, also played roles, but to a lesser extent. Understanding these factors helped John see where he could make improvements to raise his score over time. How your credit score impacts loans, mortgages, and more. After learning about the factors influencing his credit score, John Miller began to understand just how much his score could impact his financial life. When he applied for his mortgage in March 2024, his score of 620 not only led to higher interest rates, but also limited his loan options. Lenders typically see lower scores as a higher risk, so they charge higher rates to protect themselves. John's experience was not unique. A low credit score can also affect many other aspects of your life. If you're applying for an auto loan, a credit card, or even renting an apartment, your credit score can determine if you'll be approved and at what terms. For example, a score under 650 can make it difficult to secure a rental without a larger deposit, and a score under 700 might limit your ability to get a low-interest car loan. John realized that improving his score would not only help him save money on his mortgage, but also make his financial future brighter. 5 common myths about credit scores debunked. As John Miller continued his journey to improve his credit score, he encountered several myths that made him question everything he thought he knew about credit. Here are the top 5 myths he learned to debunk. Checking your own credit score hurts it. Many people believe that checking their own score will lower it, but this isn't true. When you check your own credit, it's called a soft inquiry and does not affect your score. Hard inquiries, like when a lender checks your score for a loan application, are what can impact it. Closing old accounts will improve your score. John thought that closing old, unused credit cards would help. However, closing accounts can actually hurt your score by reducing your available credit and shortening your credit history. It's better to keep those accounts open. Income affects your credit score. Credit scores are based on how you manage debt, not how much money you make. Your income has no direct impact on your score. You need to carry a balance on credit cards to build credit. Carrying a balance on your credit card isn't necessary to build your credit score. In fact, it's better to pay your balance off in full each month to avoid paying interest. Paying off a debt will immediately improve your score. While paying off debt helps improve your score, the changes might not be immediate. It can take time for updates to reflect on your credit report. By debunking these myths, John felt more confident in his efforts to boost his credit score. Understanding the key factors that affect your score, John Miller was determined to raise his credit score, and to do so, he knew he had to focus on the key factors that impacted his score the most. By understanding these factors, he could take actionable steps to improve his financial standing. The first factor, payment history, was by far the most influential, accounting for 35% of his score. John realized that even a single missed payment could have a significant negative effect. He made a commitment to set up automatic payments to avoid future mistakes. Next, John focused on amounts owed, which made up 30% of his score. He discovered that using a large portion of his available credit, also known as his credit utilization rate, hurt his score. To fix this, he started paying down his credit card balances, aiming to keep his credit utilization below 30%. The third key factor, length of credit history, 15%, worked against him, as he had only been using credit for a few years. John knew he couldn't change his credit history overnight, but he made sure to keep his accounts open to help lengthen his credit profile. By focusing on these core factors, John was well on his way to improving his credit score and securing a better financial future. The consequences of a poor credit score. What you need to know. John Miller had learned a lot about credit scores, but one of the most eye-opening realizations was how much a poor score could affect his financial life. In his case, his 620 score led to several consequences that he hadn't anticipated. First, his mortgage application in March 2024 was approved, but he faced much higher interest rates than he would have if his score were better. This meant that he'd end up paying thousands more over the life of his loan. In addition to higher interest rates, John found it difficult to qualify for some credit cards, and the ones he did get came with low credit limits and high fees. He also struggled to find a rental apartment in his preferred neighborhood. Landlords in New York City often check credit scores, and with a score below 650, John had to pay a larger security deposit just to secure an apartment. A poor credit score can also impact your job prospects. While not all employers check credit, many do, especially for positions that involve financial responsibility. John's credit history could have worked against him if he had applied for a job in that field. John realized that improving his credit score was not just about getting a better mortgage rate. It was about opening up more opportunities in every area of his financial life. As John Miller's journey with credit scores continued, he realized that improving his financial health was a long-term process, but it was entirely within his control. Over the months, he diligently applied the strategies he had learned, paying bills on time, reducing credit card balances, and checking his credit reports for errors. His score gradually climbed, and he began to see the benefits in his daily life, from lower interest rates to better job opportunities. It's important to remember that credit repair isn't a quick fix or something that can be done overnight. There's no magic solution, but with patience and consistency, anyone can improve their credit score. Whether you're in a similar situation to John or just want to make sure your score stays healthy, understanding the key factors and taking actionable steps is the key to unlocking a brighter financial future. By following the steps outlined in this video, you too can demystify credit scores and take control of your financial destiny. Don't wait for things to improve on their own. Start today and see how small changes can lead to big results in your credit score.